we want you to know.
As of November 2025, global investors are asking a familiar question. Is the stock market heading for another boom, or are we approaching a bust? The truth appears to lie somewhere in between. The world's major markets, especially in the United States and Asia, have been on an impressive run throughout much of 2025. U.S. equities enjoyed a 6-month winning streak into October, driven largely by excitement surrounding artificial intelligence, AI, resilient corporate earnings, and hopes of lower interest rates in 2026. Indian markets have also remained near record highs despite short-term volatility, while emerging markets, including Pakistan, are more cautious due to slower economic growth and currency challenges. Optimism persists, but cracks are visible beneath the surface, leaving analysts divided on whether this is the start of a sustained rally or the calm before a correction. The bullish or boom case is built on several strong pillars. Corporate profits remain healthy in most developed economies, particularly among U.S. technology giants that continue to benefit from the AI revolution and strong consumer spending. Companies have adapted well to higher financing costs, maintaining margins and earnings even in a high-rate environment. If central banks begin cutting interest rates in mid-2026, as many investors expect, equities could benefit from lower borrowing costs and higher liquidity. Major financial institutions such as J.P. Morgan have highlighted falling rates, steady employment, and ongoing digital transformation as reasons for cautious optimism. Moreover, the market's enthusiasm around structural changes, artificial intelligence, automation, green energy, and biotechnology, has added powerful thematic momentum that keeps investor sentiment buoyant. Some strategists even forecast the S&P 500 could reach 7,000 by the end of next year, arguing that AI's economic impact is still in its early stages. This momentum, coupled with improving consumer confidence and solid economic data, suggests that a continued rally is plausible in the near term. Yet the bust narrative is equally persuasive and increasingly worrisome. The most immediate concern is valuation. Stock prices, especially in the technology sector, are extremely high compared with historical averages. Analysts warn that the current market resembles past periods of excessive optimism, where a handful of dominant companies pushed the entire index upward. The risk is that investors have concentrated too heavily in AI-related names, leaving the broader market vulnerable if enthusiasm fades or earnings disappoint. Financial regulators and central banks, including the IMF and the Bank of England, have recently cautioned that the AI boom could end in an abrupt correction if expectations prove unrealistic. Inflation, though moderating, remains sticky in several regions, forcing policymakers to tread carefully with rate cuts. Meanwhile, global debt levels are elevated, trade tensions persist, and geopolitical uncertainty, from conflicts in Eastern Europe to shifts in U.S. and China relations, adds unpredictable stress to the financial system. In short, the rally is real, but it is built on fragile foundations. Economic growth data also paints a mixed picture. The United States continues to show resilience, but signs of slowing demand and rising corporate costs suggest the expansion may be losing steam. Europe remains weak, with Germany flirting with recession, while China's recovery from its property market slump has been uneven. Emerging markets are caught in the middle. They benefit from strong exports when global demand is healthy, but they also suffer from capital flight when investors seek safety in U.S. assets. Pakistan, for example, faces pressure from a strong dollar, high energy prices, and limited fiscal space. If global risk appetite drops suddenly, developing economies could experience sharper declines even if Western markets remain stable. This unevenness underscores the growing risk of divergence. where a few large markets continue to perform well while others struggle to attract capital. In such a climate, it is reasonable to expect that the market could continue its upward momentum for a few more months, possibly into early 2026, but that the probability of a correction increases the longer the rally persists. Investors have priced in a lot of good news: strong earnings, easing inflation, and rate cuts. That leaves little room for upside surprises, but plenty of room for disappointment. Historically, when optimism becomes one-sided, even a small shock, such as weaker corporate guidance, a geopolitical flare-up, or a sudden tightening in credit, can trigger a broad sell-off. Some analysts describe the current phase as the last melt-up before the fall, suggesting that the market's next major move could be downward once the exuberance fades. This does not mean a 2008-style collapse is imminent, but a 10 to 30% correction within the next year would not be surprising given stretched valuations and global economic uncertainty. For investors, the best approach may be balance and discipline. Those who believe in the long-term strength of technological innovation and corporate adaptability can still participate in the rally, but should do so selectively, favoring companies with strong balance sheets, consistent earnings, and genuine exposure to transformative trends rather than speculative hype. Diversification is crucial. Exposure to defensive sectors such as healthcare, utilities, and consumer staples can cushion portfolios if volatility spikes. Maintaining some liquidity or cash reserves can also allow investors to buy during downturns rather than sell in panic. For emerging market participants, it is especially important to monitor currency movements and global interest rate trends, as these can have a bigger impact than domestic fundamentals alone. In conclusion, the stock market today sits on a knife's edge between exuberant optimism and fragile overconfidence. The forces of technological change, easing monetary policy, and strong corporate performance could sustain a boom for several more quarters. However, the combination of stretched valuations, macroeconomic headwinds, and rising global risks leaves the system vulnerable to a sharp correction. In the short run, the rally still has momentum. In the longer term, prudence and risk management are essential. The most likely outcome is a continuation of the boom now, bust later cycle, a market that climbs higher on optimism before reality eventually reasserts itself. For investors in all regions, but especially those in emerging markets, the message is clear. Enjoy the gains, but keep one hand on the exit door.